Okay, yeah, we are live. We are live, sir.
Okay, can I start?
Yes, yes, please.
Good afternoon, everyone. It gives me a great pleasure to welcome you all to this important webinar on trade credit insurance organized in collaboration with our knowledge partner, RiverBank Insurance Brokers Pvt. Ltd. In today's volatile global market where payment defaults and political uncertainties are become increasingly common, Trade credit insurance has emerged as a vital tool for business, especially for exporters and MSMEs in the plastics industry. This session is a timely intervention that addresses one of the most critical yet under discussed areas, how to safeguard receivables and manage commercial risk. Our speaker today, Mr. Pramod Bowan, Executive Director at RiverBank Insurance Brokers Pvt. Ltd, brings deep insight from the insurance broking domain. RiverBank is a specialized insurance broking firm that helps companies manage business risk through tailored insurance solutions across the trade credit, marine, liability, and more. Mr. Pramod Bowan is a seasoned insurance professional with over 2 decades of experience in the general insurance industry, specializing in risk consulting for MSMEs. He is the founder of insurancemanager.com and currently serves as an executive director at RiverBank Insurance Brokers Pvt. Ltd. His career includes key role with ICICI Lombard's Corporate Solutions Group in 2003 to 2004. An alumnus of Wellington Institute of Management with a master's in marketing and an associate of the Insurance Institute of India. Mr. Bowan has been instrumental in building a 360-degree insurance solutions across employees' benefits, property, marine, liability, and credit insurance. Under his leadership, RiverBank has supported over 500 MSME clients with the dedicated teams for underwriting claims, risks and sales. Our joining him, Mr. Mukesh Kumar Sinha, Assistant General Manager at ECGC Ltd, India's premier export credit agency. ECGC plays a crucial role in supporting Indian exporters by providing a risk mitigation solutions against the both commercial and political uncertainties. Today's webinar will cover crucial topics including how to protect your business from delayed payments, buyers, insolvency, political risk scenarios, and how insurance can empower exporters to trade confidently across the borders. Mr. Mukesh Kumar Sinha brings over 22 years of rich experience with ECGC Ltd, having served across various departments at the organization's head office. His deep understanding of export credit risk, policy implementation, and credit insurance has made him a valuable contributor to ECGC's mission of supporting Indian exporters. In his current role as Assistant General Manager, Mr. Sinha continues to play a vital role in enhancing a risk management framework and facilitating trade security for business across the sectors. Now I invite Mr. Pramod Bowan and also Mr. Mukesh Kumar to give insights on the topic. And over to you, sir.
Thank you, Mr. Mallikarjun. That was a warm introduction. And with this, I'll just share the screen as well. Right. First of all, I would like to thank AIPMA, also our co-presenters ECGC, and my team for making this possible. It's a great opportunity for us to deliver today on credit insurance for all the members of AIPMA. We understand AIPMA as All India Plastic Manufacturers Association, which is a apex body governing all the plastics and polymer trading manufacturing companies, the entire ecosystem. In fact, today what we have also done is we have a very tailor-made presentation here, In fact, this presentation has been devised after keeping into account the lot of sub-industries within the plastic domain, including your houseware, tablewares, additive and master batches, FIBC, woven sacks, flexible packaging, pipes, fittings, writing instruments, and stationaries. And I have the privilege to tell you today that we are the only insurance broker in India who is specializing in plastic and sub-industry domain. We have clients in all these sub-industry domains. We have handled some large claims in this domain, and we would like to make this session as interactive as possible. We would share you knowledge on claims, how can you design policies, coverages. Okay. With this, I go to the next slide. This is very briefly about us. We are in the business since 2005, currently serving 250 plus corporates at an enviable claim disposal ratio of 99.3%. We are settling 10,000 claims annually for MSMEs, including property, fire insurance, factory insurance claims, transit insurance claim for marine cargo, liability insurance, and also employee insurance claims for health and accident policies. We have dedicated health claims team, and we retain our client at 93, which is enviable again. Okay, with this, I throw the session open, as in today we did a very recent survey as to what kind of business risk entrepreneurs mostly feel vulnerable to. And the survey results were out of the 8 parameters which we had given. One was, of course, the physical assets, the factory assets, and the questions were related to the critical risk component. Similarly, the second aspect was stoppage of production. The third was transit risk, goods and machinery. Employee health and safety was also covered. Similarly, cyber fraud risk, payment receivables, and defective products. And which was very much expected, we found that payment receivable was one of the most perceived risk by business owners. And that's how prompted us actually to do a full-fledged session. And we have got Mukesh Sinha ji here, who happens to be the AGM Marketing, Underwriting and Claims Function for ECGC, who will be taking us into a deep dive into the product coverages and the exclusions and how the premium workings are done. But before Mukesh ji takes over, I will very briefly throw on as to what kind of risk normally plastic manufacturing and processing industries are exposed to. With our experience of more than 20 years, I'll be very briefly touching upon those topics in very detail. Okay, the role of insurance and risk management. Everyone understands what is insurance, but normally I would start with the concept of risk. So risk is something which a business owner feels that it can hit the balance sheet, put up a big financial loss. And here, once the perception is that it can be a big financial loss, there's always a concept of risk management. And with the risk management, whether the risk has to be transferred, it has to be retained, those discussions starts happening. And when you transfer the risk to an insurance company on payment of certain premium, it is called as insurance. And I also have a very important saying here. If you don't invest in risk management, it's said that it doesn't matter what business you are in, it's a risky business. And that's how we start the session. Okay. So as I told you about risk management as we speak, what are the risks which normally a plastic processing industry will be exposed to? So the risk is of all your physical assets, which is building, plant and machinery, your stocks and stocks in process, your office assets. And then we have tried to identify what are the exposures to these risks. So this exposed risk is vulnerable to fire, flood, earthquake, and breakdown of machines. And then we have also brought what are the solutions available for business owners, businesses. The solutions available are in the form of fire insurance, industrial all risk, which happens to be a broader version. Loss of profit policies are available if the production stoppage is there. Machinery breakdown is, of course, one of the element of the risk which cannot be ruled out. Similarly, burglary and theft. So these are few of the solutions available in the insurance domain, especially on the business insurance side of it. Now, as we speak, in fact, we are flooded with a lot of queries whether war is covered for factory, because with the recent turmoil which is happening with the war which is going on, lot of these assets are vulnerable to war risk. But I would also take this platform to tell that at least on the physical aspect side of it, only in large risk there is a standalone terrorism and war cover available. A lot of medium-sized businesses are not covered because war is a generic exclusion. None of the reinsurance companies operating in India are covering war risk. Terrorism is of course covered, but terrorism should not be mistaken for war. What happened in Pahalgam was a terrorist attack, which could have been covered if there was any vulnerability. But today, what is happening between India and Pakistan is not covered under the policy. But there are other coverages like your fire, lightning, flood, storm, act of God, perils, which are all covered normally for any businesses. With this, I go to the next set of risk, which is the transit risk. Now, in transit, there is a vulnerability to what are the inwards, like for example, all your raw materials which come into your factories or warehouses, and then there are finished goods which go out of the factory. These are exposed to risk, like there's a transit risk, there gaadi palti ho sakti hai, there can be a derailment, there can be theft, there can be fire. There's a lot of risk which is associated when these goods are traveling or in transit on a truck, rail, on a ship carrier, while at being port. So what are the solutions available here? The solutions available are here in the form of marine cargo insurance. You can take an individual policy like your export policies for outward transit, imports for procurement from outside India, domestic sales, purchases, all can also be clubbed into one single policy, which is called as the marine sales turnover policy. In fact, we recently settled one large claim for a writing instrument and stationery manufacturer, where the claim was to the tune of 4 crores. To be precise, 3.78 crores. And that was a general average claim, which is like one of the vessels which had sailed from Malaysia, got fire midway in the ocean, and some of the containers had to be pushed back into the ocean. So that was a general where 4 containers were pushed into water so that the vessel could stabilize and go to the nearest port. So this is one of the large claims which we recently settled. In fact, on the property insurance also, we had settled a claim of around 20 crores for a FIBC manufacturer. So what I want to also tell you, apart from the risk, a lot of these MSMEs sometimes don't have a lot of compliances in place, with the insurance companies try to cut corner at the time of claim. But I think with the new regulation from the regulator, which allows you to customize the policy wording, there is a lot of empowerment which can be brought into the policy wordings in the form of customizations. It can be as simple as covering your dies and molds, how to insure them. If you have second-hand machineries, how you can insure, what should be the ideal valuation for these. So all those can be built up under your current policies. Right. With this, I go to the health and safety for employees. Employees are a very crucial assets of businesses, like your physical assets. The exposed are all your staff who are on your payroll, and similarly, a lot of these businesses in plastics have a lot of factories in Daman, Silvassa, and elsewhere locations where a lot of contract workers are also employed. In fact, during the COVID, there was a circular from Ministry of Home Affairs asking to cover all the employees, all the contract employees, so that there's some sense of security given to those employees and they can return back to work. So what are the risks? So the risk is of any injury, death of employees while being at work or while outside. Similarly, employee benefit policies, and there is a risk, of course, of diseases which can be contracted either due to accident or because of disease, and which requires hospitalization. So the policies or the product solutions which are available for such kind of risk is the group health insurance policies, group accident policies, and then workman compensation policies are also available, which are normally issued for contract staff. Yahan pe you have got workman compensation is now renamed as employee compensation policy. In fact, this is one of the policies where we have seen frequent claims. And we specialize. We are proud to say that we specialize in handling of these claims. Yahan pe we also bring out USPs in terms of how can we help you in benchmarking your current policies, what kind of benefits you should have. And with our mobile app, the entire process of claims becomes so easy to manage and handle. which can be provided at disposal. Right. With this, I come to the next set of the risk, which is defective product. So a lot of these manufacturers which manufacture products, sometimes to the client specifications, sometimes if it's its own brand, they do a lot of R&D activities and they manufacture these products. These products and services, there's a risk of the product being defective. It can be because of a raw material batch going wrong, or maybe some wrongful act in the workmanship. There can be various instances or some sort of gross negligence which can happen, and or there can be a product failure. So insurance companies have products called liability insurance, which normally if you export outside India to the US market or the European market, your vendors will make it compliant for you that you take such insurances. But nevertheless, apart from just a pure compliance, we would strongly recommend that this be taken as a product liability policy, because not only it covers for property damage claims कि अगर आपके product से किसी को नुकसान हो जाता है, but अगर tomorrow if the client rejects your entire lot because of defectiveness, so the recall cost is also covered. It also covers you for product guarantee, which talks about अगर if the product doesn't perform the intended purpose, which is called as pro. In fact, again in the FIBC industry, we have seen, especially in packaging, whether flexible or rigid, we have seen a lot of notifications. I would not say claims, but ऐसे customers से उनको complaints आते हैं कि आपके products सही नहीं है, आप products को वापस लेके जाइए. So those would qualify under recall related claims. Right. With this, I come to the next lot of risk. We are also getting questions, but due to the tenacity of the time, we would take these questions at the end of the session. I will complete the presentation. Right. Cyber attacks. Wherever I go these days, a lot of forums and association events, there's a lot of talk on artificial intelligence and how AI is being used in the industrial setups for how it is increasing the efficiency and ensuring that right products are delivered right times and so on and so forth. But what also it requires a lot of these data and systems to be curated. There's a lot of centralization of data. Okay. And when you do that, there is a risk of hacking. There is ransomware demand. There can be, especially for exporters who receive remittances from outside in India, there can be social engineering frauds, like your fraudulent fund transfer. Email किसी ने हैक कर लिया और एक मेल भेज दिया, आप ये अकाउंट में इतना पैसा ट्रांसफर कर लीजिए, और आपको वो डोमेन देख के लगेगा कि ये कस्टमर का ही डोमेन है, but it's a social engineering fraud which has been done. And or maybe business interruptions. Nowadays, a lot of these high-tech manufacturing units and storage units have got entirely robotic setup where the machines are being controlled by machines, and there are very few people. Entire process of bottling is automated. But what happens is with these, there is a vulnerability that these systems can be breached by intrusion. And once that happens, there can be a lot of losses related to business interruption. It can be because it can be privacy breach, data losses. If you have some sensitive confidential information of your clients, which can go in the wrong hands. So here, I would not say ki we can stop that. Of course, you'll have to take all the precautions. The best cyber security measures and practices should be adopted whenever you go for such kind of automation. But cyber liability insurance, of course, can make you a good financial loss. But liability insurances are also not about paying claims. They are about managing claims. They help you get the best forensic investigator to identify what was the cause of loss, or maybe a public relation consultant as to what kind of communication should go out in the public. आपको अपने customers से क्या बताना है, आपके regulator को क्या बात करना है, what kind of domain data, public domain communication should happen. So this is entire management apart from the financial loss. अगर if there is a third party suit और एक कोई केस हो जाता है कि आपके वजह से हमारा sensitive confidential information बाहर गया, आपके कस्टमर ने आपको सू किया, तो those kind of claims will be picked up under the cyber liability insurance. Right, this is about employee and outsider fraud, mostly related to crime insurance, which can happen because of any losses to stocks or any other cash in checks. That can be because of some fraudulent acts of internal employees or third parties. And this can be covered under crime insurance, which also is known as social engineering fraud cover. So cyber and crime are cyber liability and crime insurance are two very important covers we strongly recommend, especially for businesses which are controlled remotely. Right. With this, I come to the end of my session on creating awareness on the kinds of risks which businesses are exposed to, what kind of solutions are available. And we are very proud to tell you that we are India's only and first insurance broker which caters to plastic as an exclusive vertical. We do a lot of activities with businesses, especially gap analysis, which helps us to identify any flaws in the current program. We do a detailed audits of your current policies to identify any flaws and suggest and recommend changes. We have got industry relevant add-on covers, like for example, molds and dies, second-hand machinery, accidental, and there are a host of 50 plus add-on covers. We help you in valuations. Apart from that, many a times we have seen the most of these plastic businesses being mid-size MSME units. Even in fact, even in large turnover companies, we have seen that the entire facility is not at a single location. It is like unit 1, which is in Daman, unit 2 is maybe 5 kilometers ahead, then Silvassa. So it's just spread across. So what happens is many a times, a lot of these risk management, especially on the factory risk management practices, are not in place on fire safety. So we help to conduct electrical fire safety audits. We do thermography, which are basically infrared cameras which identify hotspot areas, and then the electrical and maintenance team can work on those areas of improvements. We do energy efficiency audits for businesses, and through this we not only help the clients understand the risk, improve the risk, but they also find more takers for their insurance, because plastic processing insurances are normally not on the preferred risk of insurance companies. But by doing these activities, we make it more I would say saleable, or the program is more attracted to the insurance companies, and they come and participate in the program. So our objective with these activities is not only to get you deal pricing, because better managed risk will always have lesser premiums, but you will have more insurance companies also at your disposal. Right, claims, moment of truth, effective claims management, right from documentation, drafting, settlement is all our responsibility. We have handled more than hundreds of claims for property and marine in the industry. Our claim disposal ratio is more than 99%. Our client retention is 93%. And right. With this, I come to the very theme of today's presentation. It's time for me to pass on the baton to Mr. Kumar, and we are here. He will take us through the credit insurance program in detail. Mukesh sir, over to you.
Thank you very much. Thank you, Arjun ji. First of all, good afternoon to all the AIPMA members, and it's my privilege to be among all of you this afternoon and provide some inputs and insights about what ECGC offering, what kind of products we are offering to our exporter clients as well as for the domestic. I believe my slide is visible to all.
Yeah, yes, sir.
So ECGC, we are basically into the trade credit insurance. If you see wherever there is a credit, there is a red alarming sign or some sign of danger is there. That's why that is the reason whenever we are going for any credit, whether it's from the bankers or the financial institutions, there will be always some kind of collaterals will be required, whether you're going for the bank loan, housing loan, motor insurance, or whatever, car insurance, or whatever the things are there. But when we come to our payment receivables, as Mr. Pramod said, that the payment receivable is one of the first and foremost risk among the various risk involved within the transactions. We have borrowed money for the bankers or the financial institutions. Our manpower has devoted some time. Goods has been made. Thereafter, goods has been shipped also. We have shipped the goods to also the overseas buyers, and the due date has come, but buyer is not paying. So what kind of collaterals we are having? Are we safeguarded? Yes or no? So to protect such losses, ECGC is there in this business since 1957. Just to give a brief about the company, we functions under the Ministry of Commerce and Industry. To main purpose of the ECGC is to promote exports. If you see the other insurance company, they are working under the control of Ministry of Finance. ECGC is the only insurance company which is under the Ministry of Commerce. That itself speaks about the what is the importance of ECGC in terms of the export promotions and the commerce promotion within the country and outside the country. Basically, we are having two verticals. One, we are providing a trade credit solution to the exporters, as well as we are also providing the trade credit solutions to the trade insurance to the bankers also. What different products are there, we'll cover in the subsequent slides. Like any other insurance company, we are also being regulated by the IRDA, and all the insurance laws and acts are applicable to us also. As of now, we are having serviced by 4 regional offices and 47 branches all over India. Our corporate office is in Mumbai. As of now, as of 31st March 2025, we have supported more than 20,000 active exporters under the direct coverage to the exporters what we are offering under the policy, as well as through the bankers which are being covered through the ECGC. There are around 2,300 bank branches being serviced by the ECGC throughout the India. So brief financials, our authorized capital is around 10,000 crore, and as of now, paid up capital is 4,308 crores. Our entire shareholding is with the government of India. So we are 100% government of India owned company. Net worth as of now is close to 12,000 crore, and solvency ratio is the one of the parameter or barometer to judge the claim paying capability of any insurance company. How sound or solvent any insurance company is there. So that is around, for ECGC, around 47.85 against the mandatory requirement of 1.5. I like to update all the AIPMA members here that ECGC is the one of the insurance company having the highest solvency in the India. If you go to other insurance company, they will be having a solvency ratio for 1.5 to 2.5, but ECGC is having a very high solvency ratio. That means the claim paying capability of ECGC is very high. To support this, as of now, we are having close to almost 16,500 investment funds. So in case of any eventualities are there, your losses are fully protected. This is the government structure board of director for the ECGC. We are having a full-time directors in form of chairman and managing director and executive director. Apart from that, there are 13 other directors, mainly nominated by the government of India, and they involve from the Ministry of Commerce, Ministry of Finance, RiverBank of India, Exim Bank. One nationalized bank CMD will be on our board, chairman of the GIC, president of the FIO. So you see, if you see all the stakeholders, they are directly either from the government companies or the persons associated with the exports. So this gives the emphasis that how much focus of ECGC is there for the export promotions. Coming to the what kind of products we are offering, we are basically having two verticals, one for the exporter and another for the bankers. Under the exporter verticals, we are covering the risk directly exported with associated with the exporters when they are exporting to the overseas buyer on the credit terms. See, if you go for any export transactions, basically there are two types of contracts will be there. One contract will be between the exporter and the buyer, that exporter has to make the shipment on credit terms or maybe on advance terms on the LC terms. And in case the exports are there on the credit terms, then buyer will take the delivery, and thereafter on particular due date they have to suppose to make a payment. What if the buyer fails to make the payment? In such cases, ECGC will come into the picture in case exporter has availed the insurance cover from the ECGC, and your losses will get compensated. If we see the banks vertical, under the export transactions, there could be second contract also, depending upon the exporters are doing the finance for their operations from their own sources or they are availing the loans from the banks. So in case the exporters are availing the loans from the banks for the packing rate and post shipments. And in case under this contract, the contract is between the exporters and the bankers. Buyer is not there in the picture in this under this contract. So under this contract, in case exporters fails to pay to the banks or financial institutions as per the terms and conditions, then the bank will invoke the cover and their losses will get compensated. So basically, today we'll discuss about, since all the meeting AIPMA members are our exporter friends, so we'll be dealing with the first kind of contract. In case you have doing the shipments or exports on the credit terms and the payments are not coming, then what are the safeguard measures so that your interest remains protected? If you see, there are basically two types of risk will be involved under the any of the export transactions when are exporting on the credit terms. When exporting on the advance terms, there is no risk because already you have received the money, and rather the risk will be for the buyer, whether they will get the goods in time or not, what will the quality of the goods. So risk is associated with the exporter, not the buyer. But whenever we are exporting on the credit terms, there are two types of risk will be involved. One will be the political risk and second will be the commercial risk. Political risk is very evident nowadays. If you see the Jensen's in the last around 2.5 years, every quarter we will be hearing a new kind of political risk is evolving. Be it latest the India and Pakistan situation going on, or maybe the Bangladesh couple of months ago, or Sri Lanka maybe 1.5 years ago, or maybe the Ukraine or Russia. So if you see the genesis, every quarter one or other kind of new political risk is emerging globally into the exports arena. So there could be in a situation that we have exported the goods, or we have our our goods has been manufactured, but suddenly the contract has been cancelled, or if you've exported, the country is not having a foreign currency to pay back, or due to the Red Sea crisis, our diversion or the journey is so long that by the time the goods is reaching the buyer is saying that I do not require the goods, or the cost associated is very high. So these are the various kinds of political risk involved. Maybe the contract cancellation, that yes, the buyer has given a contract to you and you have started the manufacturing, you have shipped the goods also, but in between the governments cancelled all the contracts. Like recently it happened with the India and Pakistan, that the goods had been sailed from our shore, or maybe they are under the consignment on has been crossed our border. Thereafter immediately each other government has cancelled that now we will not be importing or exporting from each other countries. So what are the safeguard measures? How can we protect our losses? Second type of risk involved in the under the political is the exchange risk, currency risk. That recently we have witnessed, like many countries like Egypt, or for the matter Argentina or Venezuela, the situation is that although your buyer is paying back to them in the local currency, but they do not have the foreign exchange or the foreign currency to pay back in USD or euro in the foreign currency to the exporters. So this is the other kind of risk involved, like transfer delay risk. The buyer has paid to the respective bank in the local currency, but bank is not having the foreign currency and they cannot transfer the foreign currency to your bank. So this is the second kind of risk is involved under the export transactions. War risk is always evident that in what will happen that in case of war or civil disturbances, then in case the buyer has taken the delivery of the goods and thereafter due to the war his godown is bombed, thereafter he lost all the goods and he is not able to pay back to the you. So this is the third kind of risk. Import restrictions risk recently happened with the India and Pakistan, that it will come under both the ambit, contract cancellations also, and for the new contracts, now the import restrictions are there. The Pakistan will not be importing from the India, and India will not be importing from the Pakistan. Diversion of the boys, what we discussed, that Red Sea crisis, due to the issues going on, the journey is so long that by the time the goods is reaching to the buyer is saying that my requirement is no more. I required the goods in the month of December, but this your shipment has arrived to me after 2 months. So there is no use of that good to me. So what you will do with that goods? Whether you have to look for the alternate buyer, you can resell to the other countries, or maybe you can find alternate buyer. But definitely in such cases, there could be detention charges, demurrage charges. There could be alternate buyer, they will be asking for the discount. Or in case there is no market overseas, then at least we can bring back the goods to the India. So whatever the costs are involved in such transactions like detention and damages, or the discount to the original buyer, or the cost involved in the bringing back to the goods to the India, these are all covered under the political risk from the ECGC. Second type of risk is the commercial risk, that this risk is not associated with the country. This is mainly associated with the buyer, his intention, capability, and his situations to whether he will be able to meet the liabilities and pay back to you or not. So under this, we are covering the default and insolvency of the LC opening banks, as well as we are covering the default and insolvency of the buyer. Under the insolvency, the buyer is not no need to explain that the buyer do not have the financial means and capabilities to pay back to you. So ultimately, they will file an insolvency, and thereafter, even if your name is listed as one of the creditors after the insolvency, hardly will be getting any amount out of those proceeds. So this is one of the risk involved with the buyers. Second will be the protected default. We have exported the goods, buyer has taken the delivery, thereafter maybe he is financial sound, but he is not willing to pay back to the you. So that could be one of the risk involved. Third kind of risk is repudiation risk, that non-acceptance. The goods has reached the destination, we have exported on the DP terms, the goods has reached the destination port, buyer is saying that I do not require this good anymore, or market situation is that I do not be able to sell the goods in my country, so I do not want to take the delivery of the goods. So like we discussed in the earlier slides also, in such cases, we can sell the good to the alternate buyer, or maybe we receive the good to the different country if there is a demand for those goods in different countries, or we can re-import the goods to India, and whatever the cost involved will be there, that will get covered with the ECGC. So these are broadly two types of risk involved under the export transactions if we are exporting on the credit terms: political risk and the commercial risk. There are few kinds of risk we are not covering. Commercial dispute or the quality disputes, generally we are not covering, but on case-to-case basis, depending upon the time and the nature of the dispute, we are doing the subjective analysis of at the claim stage. In case buyer has taken the delivery of the goods and due date is 90 days, and after 60 or 70 days he is saying that the quality of goods is not there. So in such cases, depending upon the correspondence between the exporters and the buyer, at what point of time the dispute has been raised, we do the subjective analysis of the case, and generally we try to give benefit of doubt to the Indian exporters. Exchange rate fluctuation is not getting covered by the ECGC. We will be covering whatever the invoice value there will be there in the foreign currency, and the bank rate applicable on that day, that will be the loss covered by the ECGC. Failure of the agent, in case any risk is there due to the failure of the agents, like we have exported the goods on the DP terms and the bank was supposed to hand over the documents to the buyer after receiving the money only, but due to some reasons, without assuring that they have received the money and they have handed over the document to the buyer, in such cases, the transaction, the DP terms, this will not get covered under the ECGC policy. It is basically a primary, it's a failure of the agent of failure of the bank and not the buyer, that he is handed over the documents without assuring the contractual obligations we had spent under the contract. Loss and damage covered by the general insurance companies, like in case we have exported the goods from Indian shore and thereafter something happens to the vessels, it has in the sea, or the fire happened during the journey time, such cases are covered generally under the marine insurance and not be covered under the ECGC trade credit insurance policy, because basically we are covering the credit risk of the buyer. Once the goods has been delivered, or once the goods has reached to the destination port and buyer is failed to take the delivery of the goods. So basically we are covering the risk of the buyer, not the general risk like fire or the marine insurance. Failure to fulfill the contract terms, generally we say that we are not covering, because many commodities there will particular size, packing requirements will be spelled, and in case we have not done the export as per those terms and conditions, so generally such losses will be excluded from the ECGC cover. To support our Indian exporter, we are having different kinds of products, starting from a small exporter policy whose turnover is less than 5 crore to the corporates having 1,000 or more than 20,000 crore also. So under the small exporter policy, our coverage is also very high. We are covering extend to the 95%, and the premium rate for the SCR policy and shipment comprehensive risk policy is both one and same. In case your exports is more than 5 5 crore in a year, then you can apply for the shipment comprehensive risk policy. Thereafter, in case your turnover is very high, and thereafter in case total premium payable within a year is more than 20 lakhs, then there is export turnover policy, wherein you will be getting a 20% upfront discount over the small exporter policy and the SCR policy. The criteria or guidelines is that the minimum premium payable on the basis of the projected export should not be less than 20 lakhs in a year. These three products are basically declaration based or turnover based policies, wherein the premium is charged on actual turnover or actual transactions. There could be certain requirement. My turnover could be very high, but my requirement on number of buyer, the limit requirement is very less, and my rotation of the limit on the particular buyer is very high. Like we are exporting on DA 30 terms or DA 60 terms. So in a year, effectively there could be 10, 5 or 6 export cycle to a particular buyer. In such cases, there is a product available with the ECGC which is not available with any of the other insurance companies, that we can offer the exposure based cover also. Rather than having exposure on the turnover, the exposure will be the premium will be charged on the exposure and not on the turnover. So in case your exposure is turnover is very high, but exposure on buyer is slightly on a more or less on the same level, a number of buyers is very high, then in such cases the multi-buyer exposure policy is more suitable. A specific shipment policy, in case you want to cover a particular shipment also, particular contract only, then this kind of policy will be suitable, in which the requirement will be that the only particular transaction or contract will get covered. Export specific buyer policy, we are having that in case we want to, we are maybe having 10 or 15 buyer, but I want to cover a particular buyer only. My remaining 8 or 9 buyers are safe. I do not perceive any risk on those 8 to 9 buyers, but there could be some probable risk in 1 or 2 buyers. So there is an option that you can cover the specific buyer wise policy. This is the turnover based policy. The same variant for a single buyer is the buyer exposure based policy. Like in case you want to cover a particular buyer or number of buyer, instead of, if you are having around 20 buyer and you want to cover only 4 or 5 or 6 buyer, maybe only 1 buyer also, then there is an option that you can cover under the exposure based also. So the premium will be charged on the exposure based policy and not on the exposure based, not exposure amount, not on the actual turnover or actual shipments what we are making. Customer specific policy, in case these off the shelf products are not suitable to meet your requirement, then we are having also option that the customer specific policy or customized covers, where a team will sit with you and will discuss that what kind of requirements are there and what are the challenges or what expectations are there from the ECGC, and accordingly we can design a product suiting your requirement. To offer such kind of product, minimum criteria is that minimum premium payable in a year should not be less than 30 lakhs in a year. Apart from that, there are other products also which I believe it will not be applicable for the like services or ITS policies. Such kind of products is not suitable for the AIPMA member, so I will not cover these topics. So as I discussed, broadly we are having 2 types of policies. One is the declaration based or turnover based policy, and second is the exposure based policy. The prime differentiation is that under declaration based policy or turnover, the premium is chargeable on the actual turnover. In case we are doing exports of 100 crores, and out of that there could be some contract on the advanced terms. So we will try to find out what is the net insurable exports every month we are doing, and thereafter the premium will be charged on the base actual transactions or actual turnovers. The requirement is that there should be, you have to obtain the limit on each and every buyer. One of the condition is that you have to obtain the limit on each and every buyer, and this is suitable mainly for those corporates or companies where there is a variation of limit. One buyer, there could be limit requirement of 5 lakh or 10 lakh, but on the other buyer, the limit requirement could be as high as 10 crore or 15 crore or 20 crores also. So exposure on different buyer is more or less on the not on the same level, and number of buyer is also very less. In such cases, declaration based policies are more suitable. Under the exposure based policy, the premium is chargeable on the exposure, and the limit is mutually agreed between the ECGC and the policyholder or the exporters, that there could be exposure of maybe 20 or 25 crores or maybe 2 crores on a particular buyer. But I perceive that at any point of time, my losses could not be more than 50 lakhs or 1 crore or 2 crore. So the exposure can be decided by the PH, and we can discuss between the policyholder and the ECGC, and the premium will be charged on the basis of that, not on the actual turnover. And generally, this suiting for exporters having a number of buyers is very high, and the outstanding or more or most of the buyers is more or less on the same line. Apart from that, we, as discussed, we are having customized covers also, where depending upon your requirement, the certain terms and conditions, or maybe the premium requirement or something may be customized as per your actual requirement. Recently, since 2023-24 also, to 2023-24, we also started giving the domestic covers. Earlier, the export ECGC was only mandated to issue the export policies only, but since 2023-24, we have started the issuing the domestic covers also. As of now, we have close to almost 75 covers in place all over India under the domestic covers. Shipment comprehensive risk policy, or these are the small exporter policy. This is the one of the sort of off-the-shelf product. It is very common and very suitable for the corporates having a turnover of around up to 20 crores. So I believe most of the AIPMA members, this product is mainly for the MSME clients, where this is a turnover-based policy, and terms of payment may be the different. You could export on the LC terms also. It could be on the DA 30 days also. It could be DA 180 days also. So transaction under this policy, all the transactions and cover on all the countries are covered. There is no exclusions under this policy. You have to cover the entire this is, we call it the portfolio cover. All the buyer will get covered under this policy. The period of cover is 12 months. So all the transactions or exports made within this 12 months period will get covered. Percentage cover is 90%, and every year, in case there is no claim, you will get additional 5% discount every year, and that premium will be charged less from the subsequent year, and that can accumulate maximum up to 50% no claim bonus. Under the shipment comprehensive SCR policy or SEC policy, the premium is a function of terms of payment and the country rating. I will give a separate slide on what are the various country rating we are having. As of now, we are having a 7-fold classification: A1, A2, B1, B2, C1, C2, and D. And depending upon the country rating and the terms of payment, like in case you are exporting on the LC transactions, the risk is very less, the premium will be less. In case you are exporting on the DP terms, then it will be slightly riskier transactions, premium will be slightly on the higher side. In case you are offering a credit is up to 90 days, then the premium rate will be different. In case credit is more than 90 days, then the premium rate will be different. So basically, under the SCR and SEC policy, the premium is determined on the basis of two factors: terms of payment and the country rating under the A1, A2, B1, B2, C1, C2, and D classification of the ECGC. There is a provision of discretionary limit that at times it may happen that you are not in a position, or the order is so urgent that you have to make a shipment to the buyer urgently. And in such cases, maybe it happened that you have applied for the credit limit to ECGC, or you have failed, or you have not applied due to paucity of time. You could not apply for the limit on the buyer. To address such cases, there is a provision for discretionary credit limit, like up to 20 lakhs under the DA terms and 40 lakhs under the DP terms. We can offer the discretionary credit limit under the SCR policy. So various terms and conditions are there that you should have some prior experience, or what would the premium requirement be there. But in order to safeguard such cases, that in case there is sudden limit requirement, there is a discretionary limit you can utilize under the SCR policy also. Under this, as per the 64BB compliance, advance premium has to maintain with the ECGC before making a shipment. So what we advise all exporter clients, that you need to anticipate your exports for the coming 2 months, and on the basis of projected exports for the 2 months, there should be advance premium in the ECGC account, and whatever the actual transactions or shipments will be there in the subsequent month, on the basis of that, premium can be remitted. So indirectly, there should be at least 2 months advance premium maintained in the ECGC account, and at the end of the policy, if you wish to continue the policy, that will be transferred in the next year policy, or it can be refunded. So it will be sort of deposit premium maintained in the ECGC account, only to ensure that you are compliance with the 64BB of the IRDA. And thereafter, second compliance with this policy is that you have to, because this is a declaration based cover, so ECGC will be able to charge the premium or account for the premium only on the basis of the actual exports or the transactions what we have done in the previous month. So by the 15th of next month, you have to provide a shipment of declaration of the shipments made during the previous month, and on the basis of that, premium will get accounted by the ECGC. This is the what we talk about. This is basically for the large corporates where the premium is more than 20 lakhs in a year. There is a provisions of 20% upfront discount over the standard premium rates under the SCR and the SEC policy. Other features remain same. The percentage cover will be 90%, and every year you will be getting a 95% no claim bonus. This policy period is also of 12 months. So criteria for export turnover policy is 20 lakhs per annum. And under this policy, there is a provision of very high discretionary limit in case, because this is basically for the large corporates. Their business is slightly more than the MSME clients. So there is an option of higher discretionary limit under the ETP policies. Other terms and conditions and compliances for maintaining the advance premium and the sending the declaration by 15th of next month is same what we discussed under the SCR policy. This is the also one of the whole turnover policy, but unlike other products, this is what we call exposure based cover. This is suitable for exporter who made frequent shipment to the multiple buyers. Number of buyers is very high. Like in case I am exporting to 15 or 20 buyers, I can afford to obtain credit limit on all the buyers. But in case my number of buyers is very high, maybe 40, 50, or maybe 100, 200, then it becomes very cumbersome process to obtain a credit limit on each and every buyer. To address such cases, this multi-buyer policy, exposure-based policy is there, wherein you get a very high discretionary limit depending upon what is the total loss limit of under the policy, and you need not to come to the ECGC up to a particular single loss limit or discretionary credit limit for approval. Like in case we are going for a policy of 10 crores loss liability, then in case losses on a particular buyer is up to 1 crore, that is fully safeguarded, and you need not come to ECGC for approval up to limit of 1 crore. Only criteria or condition is that before making, you have to verify that this buyer should not be in the adverse list of the ECGC. So moment you are having a cover with the ECGC, you'll be getting a login ID and a password. You need to verify that the buyer is not in the adverse list of the company. So this is the only compliance requirement under the MBP policy. Under this policy, the premium is charged on the exposure-based policy, and the start of the year on the basis of what is the exposure you want to cover from the ECGC, the premium will be decided, and this premium can be paid on the quarterly basis on 4 quarterly installments or upfront premium. In case we are paying upfront premium, there is the 5% discount on the net premium. Single buyer exposure policy, what we discussed earlier, is for in case you do not want to cover your entire portfolio, but you perceive some kind of risk on particular buyer, then you can come to ECGC and get cover from ECGC for 1 to 2 buyers, depending upon your risk perception. Exposure, you can decide that there could be your exposure could be as high as 4 crore on 5 crore, but you want to safeguard your risk up to 1 crore, or maybe you want to fully cover up to 4 or 5 crore, or maybe on the highest amount also. So that can be covered with the ECGC. Under this cover, the cover is generally 80% only. In case you are having a whole turnover cover, our coverage will be slightly higher, 90%. And in case you are coming for the single or standalone policy, then generally as a insurance company, we perceive that the risk is very high because you are coming for a particular transaction. In such cases, the percentage cover is only 80%. And in case this policy is also renewed every year, other features like every year we'll be getting a 5% no claim bonus will remain same as in the whole turnover policy. So only differentiation will be that under this policy, the coverage will be 80% only, unlike the whole turnover policies. And since last year also, under the initiative of the government, we have also started giving additional covers in case the policy is directly obtained through the ECGC. What we discussed regarding the customized covers, that it is only for the large corporates where we feel key of the sale products or the policies we discussed is not suitable, and there could be some kind of change in the guidelines or the compliances requirement or the specific terms and conditions. So this we are covering or issuing under the customized covers. But criteria I told initially is that the criteria to issue the customized covers, that minimum premium payable within a year should not be less than 30 lakhs. Then only the covers can be customized. And as of now, most of the covers are getting customized covers. Branches are also having a DOP, but most of the customized covers are getting covered at head office only. I was talking about the seven-fold classification of the ECGC: A1, A2, B1, B2, C1, C2, and D. Broadly, ECGC is having a countries. As of now, we are covering 239 countries. Other insurance company will be not covering more than 150 to 160 countries. But as of now, we are covering almost 239 countries. Out of that, 185 countries are in the open risk classification. That means they are economically and politically sound, but depending upon their risk perception, they have been classified into A1, A2, B1, B2, and C. Second risk classification is the restricted cover country, where as of now, economically or politically, we may have some turmoil going on, and depending upon that, these countries may be classified under the RCC1 or RCC2. Restricted country classification, RCC1 and RCC2. These cases, it will be a limit requirement under the MPP policy. All the bags under the open covers are automatically covered, but for the RCC1 and RCC2 countries, you need to apply for a specific limit on those bags. Automatic coverage will not be there. So basically, there are two types of country classification. One is whether the country is under the open cover or the RCC, or second is the rate on the basis of the rating: A1, A2, B1, B2, C1, C2, and D. As I told, we have also started issuing the domestic cover now. So broadly, the risk covered under the domestic policy is also same. Only differentiation will be that within the country will be not be having any political risk. So accordingly, the premium pricing and our structure is that, like, whatever the rating is there for the export policy, under the export policy for the political risk, that will not be there. Under the domestic policy, like trade disputes is not covered under the export policy also, same it is here also. Under domestic transaction, cash settlement and interest charges is also not covered. And non-acceptance risk, what we are covering under the export policy, is not covered under the domestic policy, because in case any buyer is not taking the delivery, then cost involved in reimporting, or rather the bringing back the good to our factory, is very nominal. So in case of non-acceptance within the country under domestic cover, we are not covering the repudiation or the non-acceptance risk. Exclusion, there is an option that you can exclude the transactions with the associates, individual, and the government or the public institutions also. LC transactions can also be excluded. Within the domestic policy also, same feature of concepts are there. We can issue the turnover-based cover or the exposure-based covers. Other features are more or less same under the domestic cover, what we discussed under the exports cover. So this was broadly the product profile of the ECGC to safeguard the interest of our clients. So this was the presentation from my side. In case any questions are there, or maybe in case you want to discuss anything more, we can discuss.
Thank you, Kumar sir. It's a very interesting presentation, especially. Mr. Pramod, can you take the questions?
Yeah, right. So we have got Mukeshji few questions here. I will just read it
I just open the chat window. Yeah.
Right. So first question related to ECGC is, what are the premium rates and applicable discounts?
Premium rates, what we discuss, is on the basis of two factors will be there under the declaration-based policy. As what I discussed, we are having two types of broader classification: declaration-based transactions and the exposure-based covers. Under declaration-based covers, it will be on the basis of the terms of payment, what terms of payment you are exporting, and which countries, what are the country classification rating, on the basis of which premium will be decided. Like for USA, LC transactions will be around 18 paise. In case you are going for the DA transaction up to 30 days, it will be 51 paise. So we are having a matrix premium chart. On the basis of that, the premium will be get decided. So broader classification is basically on the basis of the terms of payment and the country classification. Whereas under the exposure-based policy, it is not determined or dependent on the basis of the country classification on the terms of payments. The premium rate is one for all the countries, and the same is same for the various countries and the various terms of payment.
Thank you, Mukeshji. The next question here is, what will be the duration of the policy and the percentage of cover?
all the policies except the specific shipment policy, because the specific shipment policy I told is about for a particular contract only. So contract could be for the, like, we have to fulfill our contract obligation within the 40 days, 50 days, or 60 days, or 180 days time frame. So depending upon the contract of the policy, by when we have to make the shipment, the specific shipment policy could be for a lesser duration than 1 year. Apart from that, all other products are issued for 1 year cover.
Thank you, sir.
Percentage cover under the whole turnover cover will be 90%, and in case we are going for the standalone covers like specific shipment policy or SBEP, then cover will be 80%.
Thank you. The next question is, what is the time limit for filing a claim under the policy?
Time limit for filing a claim, we have given a very headroom is very high. It should be within 360 days from the due date. If due date is suppose in the month of April, then April 25, then claim can be filed up to April 26. So almost 360 days time frame is there within that. Because see, under the international transaction, it rarely happens that the buyer will be paying exactly on the due date. There will always some kind of delays will be there. Most of the cases we are seeing that the delays is up to around 60 or 90 days. So to take care of such cases, there is the option that the claims can be filed within up to 1 year or 360 days from the due date.
Thank you, sir. Next question. Here there's a question on what are the obligations. I think what are the compliances which normally a policy holder has to take care of when they go for such policies? What are the declarations or compliances?
See, compliances, what we talk about under the declaration-based policy will be slightly different. Under the exposure-based policy, the compliances will be slightly different. Because under the exposure-based policy, the premium is charged upfront on the quarterly or the annual basis. So there is no need of compliances of sending the declarations every month, because we are not charging the premium under the exposure-based cover on the basis of the actual transactions or the exports. So such compliances are not there under the multi-buyer exposure policy or single buyer exposure policy. However, under the other policy, declaration-based policy, shipment SCR policy or ETP policy or SEC policy, because we are charging the premium on the basis of the actual export. So exporter needs to submit the monthly declaration by 15th of next month, and they have to ensure that advance premium is available in our account. So these are the primary two conditions or the compliances required. In case thereafter, in case losses are there and defaults are there, then debts needs to be reported within 45 days. So other terms and conditions, the compliances will be there. But from the policy maintenance perspective wise, these are the 3 or 4 compliances will be required.
We have a next question here, which speaks about whether it will cover pharma products also.
ECGC is covering all the products. If government is allowing whatever the goods and the commodities that can be exported from the country, it should not be a banned product from the government. If anything is permitted by the government and DGFT, that everything can be covered by the ECGC. There is no restriction from the commodity wise as such.
There's the next question which is coming up. What is the credit limit application charges? I think it is per buyer, I think, asking.
Credit limit application fee, if we go into Genesis, since 1992, we are charging 500 rupees only. The money has, value of the money has changed a lot, but still we are charging 500 rupees. On the top of it, earlier there was no GST or the service tax on the credit limit assessment fee. So entire 500 rupees was our income. So now, as per the guidelines, the 500 rupees is inclusive of GST. So effectively, they will be charging 374, 375 rupees also only.
Sir, one question has come up, which is very specifically related to domestic. What are the premium rates and discounts? Can you go for only domestic case? Is what they are asking.
As of now, the government, since as I informed during my presentation that earlier we are not offering the domestic covers. Now the government has taken a mandate from the government that now we can issue domestic covers also. But the criteria is that it should be only with the suppliers which are having minimum 25% export turnover. So that is one of type of sort of mandatory requirement is there, that out of total turnover, minimum 25% should be the export portfolio, under the export turnover. Then only we can issue the domestic cover. But under the customized cases, depending upon the requirement, if the total size is more, 30 lakhs premium is there in the every year, if export transactions is slightly on the list, maybe 20% or 50% also, we can recommend to the committee for the specific approval under the customized covers. That possibility may be there.
Sir, one question, this is from myself itself. Sir, I would request you to speak about the DCL. Normally, what we also see in the market from other insurance companies, they do buyer-wise underwriting, especially in the MBEP policy where there is flexibility to cover the buyers for certain aggregate loss limit. Agar if you can really little blow out there, because I think that is something which is very unique offering from ECGC, which is not available elsewhere.
Right. Fairly pointed out, Mr. Pramod. See, all other insurance companies, they are only offering the product on the basis of the turnover. As of now, they will not be mandated by the IRDA to issue exposure-based cover. ECGC is the only company which can offer the exposure-based cover. So what product we are talking about, you hinted, is the MVP policy, where we are offering a very high amount of DCL or discretionary credit limit. Under the turnover-based policy, ECGC and the private players, other companies also, you have to obtain the credit limit on each and every buyer. But what I said, in case my number of buyers is very high, number of buyers are very high, so ideally that is not suitable, that for each and every buyer I need to come to ECGC to get a limit. So that is a very cumbersome process, and that is technically not possible. To address such cases, we are having MVP policy. In case your total export is suppose 1,000 crore or maybe 100 crores also, so there could be some exports on the advanced terms, there could be some on the LC terms also, depending upon you want to get covered under the LC transactions or not. We first try to find out what is the net insurable turnover, and after that we set up aggregate loss limit of the policy. Like for some clients, the aggregate loss limit is suppose 150 crores. Then 10% of that, that means 15 crore, that will become the single loss limit or DCL for each buyers. So exporter need not come to the ECGC in case there is a requirement of limit up to 15 crore. In case the policy limit is 10 crore, like many exporters, that will be sorts of mid-sized clients or slightly on the in the export term is around 100 to 150 crore, then ideally the policy limit will be around 10 crore depending upon the average analysis we do. So in such cases, in case we are having a policy of 10 crore, that means up to 1 crore, if limit requirement is there, you need not come to ECGC for any prior approval. You can export to the buyer at your own. That is the discretion is given under the policy. And in case of any losses only, you need to come to the ECGC that we have exported, you utilize our DCL. Only criteria I informed earlier also during my presentation, that you need to verify that the buyer is not under the adverse list. And that product is very common. Recently, only in the month of March, we have settled claim of to around 10.50 crore to exporter, and entire claim under was the DCL only. They are the one of the very large cable manufacturers of the country. So they're having a policy of more than 150 crores. So total loss is around 12 crore. So 90% of that has been settled, and entire loss was under the DCL. So we have not underwritten the buyer. Only that profile and that job has been done by the exporter only, and we have settled the claim up to the DCL amount.
In fact, sir, I would like to add one point with my experience of more than 20 years in insurance and risk consulting. Of all the other products which we go and talk to business owners, normally the perception is that we are going there and taking some insurance premium. But credit insurance is a standout product where when you go and talk to businesses, it's a business enabler. It helps companies who are growing, launching new factories. Am I audible?
Yeah, you're audible.
Yeah.
Audible.
So launching new factories or maybe launching new products or venturing into new geographies, and especially when the turnover is increasing and they have to add new buyers or maybe increase the limits of the existing buyers. I think this is only one product which is giving a lot of courage to the business owners to go ahead and do business in open geographies, open markets, whether it is domestic or export. So my personal feel is wherever these policies have been sourced, those companies have grown by leaps and bounds.
Right.
And
Like to add here, what the same thing we advise, rightly pointed out, same thing advise that MVP policy generally under the CR policy, ETP policy, the turnover based policy, there is no much higher DCL will be there. But in the MVP policy, there is enough mechanism is there for the business expansion. What we advocate that this product should not be used as only from the risk perception. In case buyer fails, then only you need to come to the ECGC for compensation. what we advocate that this policy can be used to increase your top line, because we are giving a very high amount of discretionary credit limit. So you can increase this as a tool for business expansion, and rest assured that any losses are there, somebody is there to protect your losses. So you can, in case any buyer is new to you under geography like Kenya, Uganda or Sudan, in such cases also, sitting here taking a call whether I should export or not, it's very difficult. So why to lose business opportunity? In case any business opportunity is there, we should take it and export, do the exports after availing insurance cover from insurance companies.
Mukesh, I believe you've got a guest here who would like to share his experience. Agar if you can invite your guest to share his experience.
Right. In fact, when the proposal came for this AIPMA program, we have couple of AIPMA exporters having availing cover from the ECGC, and one of exporters is all-time plastics. So I believe Sudhirji is here.
Yes, sir.
Yeah. So recently, I like to update that under the DCL only, discretionary credit limit only, the claim has been settled to them, and I request Sudhirji to share your experience.
Yes.
How was having experience?
Yeah. Good evening, everyone. And regards from All Time Plastics Limited. And thanks to AIPMA, Mukesh sir from ECGC and Pramod ji to give opportunity to share my views. My experience is initially we have only couple of specific buyer policy from last 3 to 4 years. But in the year 2023, one of our customer from UK has declared bankrupt. Luckily, we had taken the ECGC cover of the same customer. Immediately, we have started procedure with ECGC, and upon their guidance, we started to process for loss minimization steps. But unfortunately, the situation is not in our control, and henceforth we submitted the claim for full amount. ECG settled the claim very short period and up to 80%. What is the limit was there? In between the course, we visited ECGC office, Mukesh sir and their officers also visited our office, meet our MD to understand our business, and we understand the multi-buyer policy, the benefit of multi-buyer policy. They approach us for the multi-buyer policy and explain the benefit of the multi-buyer policy. The management get convinced and we go ahead with the multi-buyer policy for all our customers. We have customers like IKEA, Tesco, Target, Michaels. These are like our brand retailers. Also in between, we have attended some exporters meet program of ECGC. It's couple of exporter meet program and the training provided by them, how to monitor our customers, how the process to follow after due date, delay in payment, claim procedure, everything the process they explain very well, which is very easy to understand and very easy to follow the steps. Also, they have developed a portal. It's very user-friendly portal, so you do not need to approach officers again and again. The portal is very user-friendly to operate. Searching the credit limit of any new buyer, which is help us to finalize the deal, and the portal support also submit us to file all the returns and submissions. So that's from my end. And thank you very much to ECGC and AIPMA.
Thank you, Sudhirji. Thank you. And as Sudhirji informed earlier, they were only insuring the specific buyers. And depending upon, we went and met their MD, Mr. Kailesh, and thereafter we got the business profile, that what is the business profile, what are the challenges in insuring the entire portfolio. They said that around 60% of their transaction is going to a particular buyer like IKEA, and there could be some large buyers. So accordingly, we have given a customized covers to them, so that export to the IKEA or is totally excluded. That will be not be falling under the ambit of our exports covers, because namesake IKEA is a very safe buyer. We also feel why to unnecessary charge a premium on the buyer where exporter is very comfortable. So we've given a customized cover to them, and now as of now their entire portfolio is have covered except the exclusions they have opted. These 2 or 3 exclusions they want excluded from the preview of the policy. Thank you, Sudhirji. Thank you.
Thank you, Kumar sir. I mean, very interesting discussion. Aditya, can you go for vote of thanks?
So there is another question, I think. that, Can we?
Okay, I'll take the question. Yes, this question is again, Mukesh ji, for you. Can we give credit limit for sanctioned countries and war zone countries, buyers from those countries? Can we give the limits or cover?
Yes, that is also very unique to ECGC. We having a country classification of 239 countries. So we say that the none of the countries is off limit, that we cannot offer the credit limit. As of now, only the Pakistan is the one of the country where due to the government till last week, we are covering the export to the Pakistan also. But as of now, since both the government has decided that not sort of import or export restrictions are there. So as of now, only the Pakistan is where we will not be able to cover in transactions. Apart from that, as of now we are covering all the transactions. Differentiation is only under the restricted cover country. We'll be doing a buyer analysis of each and every buyer, and depending upon the buyer profile and the country profile, we'll be giving a transactions by limit under the RCC2 countries. Whereas in the RCC1, the limit will be valid only for 1 year. So as of now, only Pakistan is off cover. All other 238 countries are getting covered with the ECGC.
Wonderful.
Any other questions? Any other questions? No.
No.
Aditya,
Yeah.
can you go for vote of thanks?
Yes, sir. Sure.
So, ladies and gentlemen, as we conclude this enriching and highly informative webinar on trade credit insurance, I take this opportunity to extend my heartfelt thanks to all those who made this session possible. Firstly, I sincere thanks to our distinguished speakers, Mr. Pramod Bhuvan, Executive Director, RiverBank Insurance Brokers Pvt. Ltd, and Mukesh Kumar Sir, Assistant General Manager, ECGC Limited. Your presentations were filled with the practical insights and clear explanation on how our members can safeguard their receivables and trade with confidence. Our gratitude also goes to the RiverBank Insurance Brokers Pvt. Ltd, our knowledge partner, for their continued support in educating and empowering our industry stakeholders. To ECGC Limited, we are especially thankful for your presence and for the incredible work you do in de-risking India's export ecosystem. And finally, to all the participants, thank you for your time, engagement. We hope the webinar gave you a deeper understanding of how trade credit insurance can be a vital ally in certain times. As a reminder, if you have additional queries, feel free to reach out post-event or drop your questions in the chat box. Our team will work to address them with the experts. Thank you once again. Wishing you all the safe, secure, and successful business journey ahead. Sir Mukesh, just I wanted to mention the AIPMA has studying recent US imposed a lot of tariff for the different countries. Sir.
Right.
No? And even if we look at the potential of the our export, present our export is 40,000 crores, and we have a potential to grow in 4 times. With that note, we are in the process of studying 21 countries. Based on these 21 countries, potentially from where they are importing plastics. But India's percentage, if you look at it, is very minimal. So we are studying, I mean, that is a new initiative. We have been doing it for last 1 year, and shortly we are completing that study. And also we are organizing all over India, I mean, Delhi, Ahmedabad, Mumbai, where plastic hubs are there.
That means a lot of potential is there for our AIPMA members to explore the
boosting,
overseas market.
That conference is boosting India's plastic export to 4x. Make in India, make for the world is a theme.
Right. That is the motto of the government.
Yeah, that's what. I mean, recently I met Deputy Director General of Foreign Trade. I mean, he was very much impressed. I mean, Indian plastics have a huge potential, sir. Deputy Director General of I met him in Udyog Bhavan. He was truly Ministry of Commerce is encouraging for us.
No, anything is there from you want the support from the ECGC, because we are also with some country profile, or you want to be associated in some kind of study or the maybe analysis, we'll be more than happy to be associated and do some kind of study for
recently, sure, sir. And recently we approached around 21 countries, and even our Indian embassies in overseas, they are fantastic in responding. They are sharing the buyers in their country, buyer listing, buyers and importers list.
No, that way, earlier we have seen a vast change during the last 7 or 8 years. As part of the claim settlement, generally we are writing an email to the embassies also that one of the Indian exporter has quoted so and so buyer and they have not paid. Nowadays, we are seeing that immediately the embassies will be replying, and in some cases they'll be also writing to the buyers, and the buyer will be ultimately paying to the Indian exporters also. So nowadays they are very supportive and they are very active at that way.
Very active, yes. Yeah. Immediately we are getting the response from Indian embassies in overseas, sir.
We have also noticed the same, sir. Right, sir.
Yeah. Thank you, sir. Thank you so much.
Thank you to
all. Thank
the
you, Aditya. Thank you, Pramod, sir.
Thank you,
Smita.
sir.
Thank you, everyone.
Thank you, Smita.
Thank you very much, sir.
Thank you to RiverBank and AIPMA
Thank you,
members.
sir.
And not
Thank
last
you,
but
Pramod,
not
sir.
least, RiverBank.
Thank you, Mukesh, sir.
Thank you.
Aditya, thank you so much.
Sorry.
Mallikarjun, sir, thank you.
Thank you, Smita.